Evening, Green Cross Paddy here. I stumbled across this chart a few weeks ago and I found it extremely interesting to look back over the longer term. What caused me to have a look at this was a price earnings ratio chart on decisionpoint.com, which I haven't put up on here, but Carl Swenlin there uses GAAP earnings only, the old way of measuring earnings, which based on past results, not forecasted earnings, which was the nonsense that seemed to have materialised before the last crash, which made people think the PE ratio of the S&P was fine, when in fact it was actually quite high historically. And I've gone to the trouble of just adding, because this was up to 2004, I've added the latest movement in the charts to complete the data up to date. And the key thing I was looking at really was for a long-term chart for the price earnings ratio, which is quite hard to find. If you want to have a look at this chart, if you go to minianvil.com, it should be on there. Or if you search for Dow Jones price earnings ratio under images in Google, you'll probably be able to find it there as well. So what I want to have a look at is really the bear and bull phases over the years. I could talk about this for quite some time. It's interesting that one thing you don't tend to find when you look on charts normally provided is anything before the depression that was in the States. This section here of the long decline over that 3 years when the stock market imploded, before that there was a consolidation phase which led to the stock buying process. And if we look down at the PE ratio at the time, the PE ratio just before the stock market went parabolic was extremely low. The stock market was in the doldrums and had been for over a decade, and that was a sideways consolidation here. So this kind of corrective mode, typical of a wave 4, would make you think this was a wave 5. There's a lot of conjecture about the read of the wave since. This could be a wave 2, and that would marry up quite nicely, whether you think that was wave 2 ending there, or an ABC ending there, leading to a wave 3, and then this could be wave 3, that could be the wave 4, and a wave 5 to the 2000 top, completing the wave 3 in entirety. Or as I prefer to think, this is wave 4 of wave 5, and that was wave 5. The reason why I think that could be wave 5 is if this is the bottom of wave 4 and the bottom of the crash in 87 was the bottom of wave 2, if you join those two up, the high in 2008 or 2007 does form the same line with the top in 87. So according to Elliott Trader's theory that wave 2 and 4, provided wave 5 and wave 1 tops coincide with that parallel line also, you can exclude any blowout action out of the parallel lines, so that would form an impulse channel. And that then means that we've had a wave A and a wave B, and the action has been similar to a B wave. It's been quite sharp and strong move, so that could well be a B wave, and then we get a C wave. There's also another way of reading it. If we just look outwards again, and we've got here a strong correction, An alternation of corrections in Elliott wave theory means that we should have a complex correction next. And obviously we look at this one as the complex correction. However, this is a smaller scale, the way most people read it. And this was a wave 2, and that's a wave 4, and that's a wave 5. And this is 2 and 4 of 3. Or was that 2, 3, 4, 5? That would work as well. So that could either be the termination of a cyclical bull, and we're now in a cyclical bear, or we could be in wave 4 of the cyclical bull. So many ways that Elliott waves could suggest things are going to pan out. Now let's look at the price-earnings ratio. The one thing I've remarked on this, when we look at it, and if I zoom right in on here, it might be hard for you to see this on the video, but you'll notice that the phases are, we go into a speculative phase and then a consolidation as people get disinterested in the stock market because it doesn't generate returns, and then it goes back into a boom phase again. Now we had a low here and we got into an excited phase and we crashed on PE ratio, and what you'll notice is the PE ratio seems to retrace almost all of the previous rally. And this happens religiously. If you look at the rally out of here, PE ratio fell well back again, under 10, and even that rally within this previous action, rally within an action, then that falls back to almost where it started from. And also on this rally here, PE ratio fell well back behind again, and in fact if you excluded this action here from the very low point here, we came straight back again. So this would make you wonder that from this low point here with the dot-com bubble, and we're on our way down, that we've still got some way to go. So that would mean that the PE ratios have to fall even more. The other thing I want to show you is, for clues, the PE ratio seems to tie in very nicely with tops in the market. The top here and the top here showed peaks in the PE ratio. And in fact, this top here, although it was a sideways consolidation after, it did tie in with the top in the PE ratio. And also the 1987 top correlates with the PE ratio. However, the top in 2000 has not coincided with the top in the PE ratio, because we've since had a divergence. If you'll notice, we reached another high on the stock market while the PE ratio fell. Has this happened before? Well, it has happened before, but it hasn't happened for quite some time. If you look back to the peak in the PE ratio at the turn of the century, 1902, it peaked and the PE ratio fell. However, the market made a new high in 1906 at a lower PE ratio, and that divergence in that situation led to further falls in the PE ratio, but in fact the market didn't fall in the same fashion, it moved in a sideways fashion. Now, does that mean that we're going to carry on moving in a sideways fashion with this large divergence? Based on past experience, we'd say yes. However, it could be that this divergence plays out differently, because here we have a flat correction, here we have a strong correction, and here was a flat correction. So it went flat, strong, flat, flat. We're due a strong correction. I'll leave you with that.